The fundamentals of qard. Borrowing or qard in Islam is a contract of virtue between a person who has funds and another who needs the funds to help the latter tide over a temporary financial difficulty. Qard is based on the concept of tabarru, helping the needy and concern for others' well-being. Sharia emphasizes the promotion of brotherhood and benevolence amongst Muslims. Wealth, rather than being in the hands of a few, should circulate widely in society. Islam encourages the practice of qard al-Hasan as stated in the hadith of the Prophet, peace be upon him. One who releases his brother from difficulties, Allah will release him from the hardships in the hereafter. Qard is derived from qirad, which means to cut. Part of one's property is cut when it is given to the needy. Hasan originates from ihsan, meaning kindness to others. Al-Qard al-Hasan means a gratuitous profit or interest-free amount to the needy for a mutually agreed period. The receiver of Qard al-Hasan repays only the original amount of the financial assistance. Underprivileged children like Amir exist amongst us, and there are those of us who, by the grace of Allah, are prosperous. Sharia emphasizes the promotion of brotherhood among all Muslims. Islam attempts to bring about justice and promotes benevolence in the society. Islam also prevents the accumulation of wealth in the hands of a few people. Hussein, a wealthy person in the neighborhood, extends a qard al-Hasan to Amir's father for his medical treatment and also to finance Amir's education. 2 decades later, Amir is a diligent doctor in a hospital. True to his ambition, he is able to cure his father and many others. Amir has repaid the qard al-Hasan from his generous neighbor Hussein, without interest of course. Difference between qard and dain. Funds borrowed as qard are repayable on demand. Qard, or a gratuitous amount given to the needy, must not be confused with the Arabic term dain, which is debt. What is debt? In a cash sale, the buyer makes the entire payment of the price on the spot. He does not owe any further payment to the seller on that particular transaction. Thus, there is no debt created. Debt is the outcome of a credit transaction. A debt is created when the buyer postpones or defers the payment to a future date. The amount cannot be demanded before the agreed due date. Both qard and dain reflect liability to pay. In that sense, every qard is also a dain, but every dain is not necessarily a qard. Here's an example. An Islamic bank sells a car on Murabaha to Abdullah for 30,000 dirhams. The agreed profit is 5,000 dirhams. Abdullah is in debt to the Islamic bank for 30,000 dirhams. He will pay this debt, or dain, to the Islamic bank over a period of 48 months. The Islamic bank cannot demand early payment from Abdullah, as this is a credit transaction where there is a profit element of 5,000 dirhams. Unlike a dain, qard is a voluntary act by a lender who lends money without expecting any return or profit. Thus, the lender can call back the amount lent at any time in case of need. In Islamic finance, every offer of financial assistance should be Qard al-Hasan. Any profit or return on qard is riba and therefore not in compliance with Sharia. Unlike a dain, qard is a voluntary act by a lender who lends money without expecting any return or profit. Thus, the lender can call back the amount lent at any time in case of need. In Islamic finance, every offer of financial assistance should be Qard al-Hasan. Any profit or return on qard is riba and therefore not in compliance with Sharia. Qard, for raising current deposits. Islamic banks apply the concept of qard predominantly for raising current or demand deposits. Current account deposits are considered loans that have to be returned by the Islamic bank when the depositor demands it. No profit will be paid to the depositor for deposits in current account. But there may be instances when an Islamic bank may provide some form of return to current account depositors. Let us suppose various depositors keep various sums of money in current accounts with an Islamic bank. At the end of the financial year, the Islamic bank may earn a profit exceeding its business target. The Islamic bank finds that the current account portfolio was largely responsible for the substantial increase in its profits. It may therefore declare a percentage of profit as a gift to its current account depositors. This voluntary decision of granting a gift to its current account depositors or the qard lenders is not considered riba. If giving gifts to the current account holders becomes a regular practice, it would imply that the loan necessarily yields a profit and it becomes riba. Current account deposits are also known as wadi'a deposits. According to Sharia, when the amana is used by the ameen or trustee, it becomes a loan. The ameen has to repay the full amount to the qard lender, even if the ameen has suffered a loss in his business. Here is what we have learnt in this module. We learnt about the concept of Qard al-Hasan. Qard al-Hasan is a kind of gratuitous, interest-free financial assistance given to the needy for a fixed period. There are two arrangements in the banks which use the concept of qard. 1. Qard or profit-free loan from customers to the Islamic bank in the form of current account deposits. And 2. Qard al-Hasan or gratuitous profit-free loans from the Islamic bank to needy customers. The lender of a qard is allowed to charge the borrower the actual administrative expenses incurred in the process. The lender of a qard can ask the borrower to provide an asset as a collateral or acceptable guarantors. The parties in a qard transaction should be legally capable of entering into the contract. They should be majors, that is 15 years and above, and of sound mind. A lender of a qard can make an early demand for the loan from the borrower, but this is generally discouraged. The Quran and the Sunnah encourage the implementation of Qard al-Hasan in the society. You may now reinforce your learning by going through this topic in the illustrated textbook and check your comprehension of the subject by attempting the questions in the workbook. In the next module, we will learn about another tool used by Islamic banks for raising deposits, called Mudaraba. Brief analysis of risks in Murabaha. There are many risks for Islamic banks in Murabaha. Imagine what will happen if the price of the car changes before sale to the client. Any damage to the car before it is actually sold to the client is also the bank's responsibility. These risks will increase the longer the car remains in the ownership of the bank. Without even knowing you, we run the risk of your failure to pay on time or default The late payment risk. The late payment penalty does not become a part of the bank's income. It has to be given to charity. Murabaha is a fixed return type of finance and is exposed to return rate risks. If the bank sells the car for a credit period of 5 years, it cannot increase the price even if the general prices or the profit level in the market or the benchmark in the banking sector rises. As against this, in interest-based banks, the rate and the amount payable by the client goes on increasing with the market rates. Some related issues. The marked-up price, once agreed upon, cannot be changed. This is a sale, and once the deal is finalized, the ownership of the sold goods and the risks and the rewards associated with it gets transferred to the buyer. The seller has the right to the credit price that has been agreed upon. This is also to avoid any gharar between us. Similarly, rollover murabaha is not allowed, as it means that the bank is getting interest on the debt that it had created by way of murabaha. Murabaha cannot be used for paying bills. That is not permitted. Let me clarify. Understanding the spirit of murabaha. Many financial institutions commit mistakes in interpreting the spirit of murabaha. The most common mistake is using murabaha for all types of transactions and financing. Murabaha can only be used where there is a tangible item intended to be purchased by the buyer. For example, a factory can avail murabaha to purchase raw material like yarn, but cannot get money to pay salaries or electricity bills. Another mistake often committed is when a bank sells an item before it is actually acquired from the supplier. Murabaha financing cannot be implemented on items that are already purchased by their clients from the vendor. If the bank purchases the item from the client, then it is a buyback scheme, which is not permitted by Sharia. Another possible mistake is that the bank appoints the client as an agent to purchase the goods. The client purchases the goods as an agent and uses it without executing the actual murabaha sale. This sale is not valid. Let's recap what we have learnt in this module. The concept of murabaha, a cost plus sale. Murabaha is a transparent sale. Here, the seller has to declare the costs incurred in acquiring an item to be sold, in addition to a profit which will be mutually agreed upon with the buyer. A murabaha transaction in which the sale price is agreed to be paid in lump sum or in fixed installments on a deferred basis is called murabaha muajjal. We learnt about the steps required to carry out a Sharia-compliant murabaha transaction. Rebates on early payment of the murabaha are considered non-Islamic. Also, penalties levied by the bank for late payments, if made part of the bank's income, are also non-Islamic. All murabaha transactions are fixed-rate products, and a rollover in the transaction is not permitted. We also learnt about the various steps taken by the bank to protect itself from willful default by the client. Some common mistakes made in the interpretation of murabaha were pointed out. Murabaha schemes are presently used to finance purchase of automobiles, houses, goods, equipment, furniture, or any tangible thing of value from a third party. You may now reinforce your learning by going through this topic in the illustrated textbook and check your comprehension on the subject by attempting the questions in the workbook. Our next module will introduce you to the concept of ijara. Repayment of a murabaha. You can repay in equal monthly installments for which we will accept post-dated checks. This is also called Biya Bitaman Ajil, which is a deferred payment sale at the duration and price agreed to by both parties and is payable in fixed installments. Rebate on early payment is considered non-Islamic. Murabaha is a trade. Here, the prices have to be fixed once and for all, and the debt created cannot be increased or decreased, keeping in view the time of actual payment. However, even if a prepayment rebate is not agreed upon in the Murabaha deal, the bank can give a rebate at its own discretion. Rebate is not a right of the buyer. Islamic Bank can consider giving a rebate to its clients as an act of benevolence. Similarly, the bank cannot charge more than the agreed amount of murabaha price even in case you delay the payment. Otherwise, it will be riba. Types of sale contracts in Islamic banks. Kabir learns about the different types of contracts he can enter into with an Islamic bank to fulfill Najma's wishes. He can get various assets with financing facilities from the bank. Murabaha, or a cost-plus sale, is a contract where the seller declares the costs and adds a profit upon mutual agreement with the buyer. For example, a contract with the Islamic bank buys a car and sells it to Kabir with an agreed profit margin. Diminishing musharaka, also known as partnership financing, is another common financing technique used by Islamic banks. For example, a contract where the Islamic bank purchases a house in partnership with Kabir. Ijara is a hire or lease contract where a physical asset or services or expertise are hired against payment. For example, in Ijara, the bank purchases a car and leases it to Kabir. The bank will be charging rent and may also cover its cost. At the end of the lease, Kabir may purchase the car from the bank at its fair value. Tawarruk is a means of generating cash by way of trading, which combines two separate sale and purchase transactions. For example, Islamic Bank sells an item to Kabir on deferred payment basis and then sells the same on behalf of Kabir to any third party to generate liquidity for him. Salam is a trade-based forward financing technique in which the commodity purchased becomes a debt owed by the seller. For example, a contract where Kabir sells ready-made garments to the Islamic Bank at a future delivery date against spot payment of price. Istisna is a kind of forward sale where a commodity is transacted before it comes into existence. For example, a contract of works in which the bank enters to construct a house for Kabir. Let's recap what we have learnt in this module. Sale or bay'a happens when one exchanges a thing of value either with another thing of value or with cash with mutual consent of both parties. The law of sale is the basic model of the Islamic law of contracts. The conditions for a valid sale contract. For a contract to be valid, the wording of the contract is very important. There should be an offer which is accepted, and the contractors must be sane and mature. The 5 khiyars or options to rescind a sale contract are khiyari shart option of condition to revoke, khiyari royat, option of inspecting goods, khiyari aib, option of defect, khiyari wasf, option of quality, khiyari gaban, or option of price. You may now reinforce your learning by going through this topic in the illustrated textbook and check your comprehension of the subject by attempting the questions in the workbook. In the next module, we will learn about murabaha. The law of contracts and the sale contract. What is a sale? A sale or baya happens when two parties exchange a thing of value with either another thing of value or cash with mutual consent. A sale, aqd al-baya, may be in the form of cash, credit, or a forward sale. Islamic banks purchase goods with cash payments and sell to their customers on credit. Islamic law of contracts. The contract law is laid down by the Holy Quran and the teachings of Prophet Muhammad, peace be upon him. It is further elaborated by Islamic jurists. The two underlying rules of any contract would be prohibition of riba or interest and prohibition of gharar or absolute uncertainty.